Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Richard Clarida is here, the vice chairman of the Fed, a prodigious economist associated with dynamic stochastic general equilibrium theory. We're not going there. People drive off the road. But we are thrilled that the former vice chairman is with us this morning. James Earl Carter, has to fill Michael Blumenthal's slot. He migrates the Fed chair over to Treasury Secretary and goes, now what? And he picked Paul Volcker. Where were you when he did that? And in 79, were you at Illinois at the time?
I was not. I had just graduated Illinois, and I think I was in my car driving out to Boston to start graduate school at
Did you
Harvard.
go Paul who?
Oh, no. He was already known, at least in macro circles then, but yeah.
It
was a big deal. It was a
huge deal.
Yeah. Historic.
The inflation worries we have now, and part of that is OMG back to the 60s, that we're going to get inflation, not like what Volcker faced, but a higher inflation. Do you buy it?
Oh, no. Ultimately, we're going to get the rate of inflation the Fed wants, and I think the Fed wants inflation around 2%. There's always shocks and noise, but that's where we're going to end up.
How are we going to get there? I mean, are they going to have to? I mean, it just feels like that inflation is kind of sticky around this level here. How do you think this is going to play out?
Well, I agree. In fact, if anything, the bumpy road analogy has proven to be a good one. Progress continued in 24, but slowed. I think we maybe discussed when I was on your show before, hearkening back to the 80s and so, what we could see is what we used to call opportunistic disinflation. That is, you do the heavy lifting, get inflation close to where you want it, so now say 2.5, but you basically wait till the next recession to cover that last mile. And so that's what we may see, inflation in the low to mid twos until the next downturn.
Are you forecasting a downturn anytime?
Oh, no. But remember, we haven't repealed the business cycle. So I think the unconditional chance of a recession is about 1 in 6. So at some point, we're going to have a recession.
April of 4 years, back when the Red Sox had a chance, Richard Clarida at the Fed, let me quote exactly, folks. Ooh. I mean, this is just what it's about. Sparta gets angry at me when I quote Latin.
Okay.
He's like, Tom, give it up. Clarida. Inflation that averages 2% over time represents an ex-ante aspiration of the FOMC, but not a time-inconsistent ex-post commitment.
Yeah.
You lost some of us there, old difference equation guy. What is a time-inconsistent ex-post commitment?
Well, I think that was probably Vice Chair Clarida channeling Professor Clarida. The basic point was that price stability means that expectations of inflation are anchored at a low number. So say 2%. There are always going to be shocks, oil shocks, whatever. Yeah. But you want people to expect over 5 years that inflation is going to be 2%. And so really, inflation targeting is really about targeting expected inflation. And so the basic idea there is if you want people to expect inflation is going to be 2, you want to try to keep it at 2 on average.
Okay, I'm going to go over to the new school of social research, Kyle Bronner and company. There's something new. It's called the debt in the deficit. Yeah. Are we losing our anchored ability with the debt in the deficit where it is?
Well, it makes the Fed's job a hell of a lot harder. There's no doubt about it. And I'm glad, Tom, that you mentioned both debt and deficit because they're both relevant. The deficit is how much we're borrowing every year going forward. The debt is how much we borrowed in the last 250 years, and that number is now north of 100% of GDP. And the last time we saw a number like that was in 1945 at the end of World War II. Indeed, Reinhardt and Rogoff wrote a book 10 years ago that said, usually when debt gets 100% of GDP, bad stuff happens, and so it will make the Fed's job harder for sure.
I've been on Wall Street since 1986. We've been talking about deficits and the debt since 1980, at least then. Is it ever going to come to roost? What will it be? We have an auction for United States Treasuries and nobody shows up?
Well,
Is that
it's a great point because I started my career around the same time, also in Boston. So the boy has now cried wolf for 40 years. But back in those days, people were angsting about debt and deficits, but debt was 30% of GDP, not 100.
Right.
And so as the numbers get bigger, but the U.S. can kick this can down the road because we still are the global reserve currency. So it may take a while.
We welcome all of you across the nation. I just can't say enough about the schedule today. Thank you, Liz Ann Saunders and Craig Moffett, the former vice chairman of the Federal Reserve System, Richard Clarida of Columbia and PIMCO, with us this morning. Richard Clarida, let's go back to Gertler and Clarida and the theory, the mathematics, the complexities of DSGE. Yeah. You've had the courage to say, I'm thinking simpler now.
Oh, yeah.
Do we have an operative theory at the Eccles building if everyone's thinking simpler in the new humility?
Well, I don't think the Eccles building or now the Martin building can afford to be that theoretical. Indeed, my 4 years at the Fed really impressed upon me that there's a limit to how far theory can take you. It's a good place to start. I think all central banks, including the Fed, are trying to learn lessons about the inflation and the disinflation. And I think an appropriate level of humility is probably warranted right now.
The labor market, we're going to get some more labor market data today with initial jobs claims, and then on Friday with the non-farm payrolls. I don't know, 4.2%. That seems like a good labor market.
It's a great labor market. The unemployment rate right before the pandemic was running right around 3.94%. The unemployment right now is historically low. Wage gains exceed inflation. It is a good labor market. The labor market clearly was overheating a couple of years ago, but it is a good labor market.
You just said it's a good labor market. I've heard you say it's a solid economy. Yeah. I got 82.8% of our listeners and viewers saying the vice chairman's nuts.
Okay.
And that it's a disaggregated economy.
Well,
and there's people out there, charge card debt, bankruptcies, people can't get jobs, etc. Rents coming down out west. How does a Fed prosecute a barbell America?
Well, okay, so I'm glad you gave me an entree here. So when I said it's a good labor market, you would rather be operating with a 4% unemployment than a 14% unemployment. But absolutely, Tom. Indeed, if anything, I think the last 5 years have impressed upon me how important it is, both for macroeconomists and thinking about the political economy of macro, to understand that there are haves and have-nots. And, if you own your home and if you own stocks, you've had a great 5 years. But 40% of Americans don't own. They rent and they don't own stocks. And for them, all of this talk about a great economy just seems like gibberish. So let me acknowledge the point.
30 seconds here just to finish the thought. Can a Fed prosecute one monetary policy for two John Edwards Americas?
Well, the Fed only has one tool, which is interest rates or jawboning about interest rates. And so what the Fed at best can do is it can keep the average rate of unemployment low and it can keep the average rate of inflation low. But the factors that we just discussed and even more factors are really beyond what monetary policy can address.
Paul wants to get to the adult conversation on tariffs, so I'll be the rude one. Can you serve at Treasury with Mr. Bessent? Have you made the trip to Mar-a-Lago?
No.
Are you under any consideration by the administration for your valued services?
I love doing what I'm doing, so the answer is no.
That's your cue, Paul.
That's my cue.
I was just putting the Clarida timeout chair.
I mean, Lisa Mateo's been reporting on more tariff news here coming from this president. It seems to be an economic policy tool that this incoming president really is going to rely upon. Can you give us your 2 cents on tariffs and kind of how we should think about them?
Okay, tariffs are complicated because they have multiple effects. One thing we know for sure, they do raise revenue. The other thing we know is they'll put upward pressure on the price of imports. How much is hard to estimate, depends on if companies absorb it in the margins. They can also invite retaliation, which also then influences our ability to export. And so it's really been a number of decades since we've had broad-based tariffs. I think you'd have to go back really to the early 1950s to look at levels of tariffs like some are talking about now. So pretty complicated, but we know for sure they raise revenue and they put upward pressure on prices.
Who do they raise revenue for? Do they raise revenue for the U.S. government?
Well, mechanically, because if you import something and you have to pay a tariff on it, that revenue, which is now zero, roughly zero, will go up.
Okay.
So,
I was in Clara didn't know this, but I was in the back of the classroom at Columbia.
Okay.
The curve went down when I showed up. This is way more complex than the media discusses.
Yeah.
And the answer is there's a thing called a deadweight loss in our tariffs price theory. Professor, describe what a deadweight loss is for our listeners and viewers.
Well, boy, that is Econ 101. That's the
101
advanced question.
Paul Krugman caught up and said, ask him about deadweight loss.
Essentially, the revenue that the government raises is more than offset by the losses to consumers and producers relative to their ability to either consume goods or produce goods, and so that's the deadweight loss.
By definition, it's a lose game. That's the key thing.
But the important proviso that almost any tax that raises revenue generates some sort of a loss, whether or not it's a consumption tax or investment tax. Yeah.
But the heart of the matter here, to go to Krugman, is magnitude.
Oh, sure.
You can do. It's almost like negative interest rates. You can do tariff light. Doesn't matter. And what the president-elect wants is a magnitude of big tariffs. Is there a tip point where Trump's right and they work?
Well, again, it depends on how long they stay on. One view is that you put tariffs on, countries basically then come to the negotiating table and then they come off. And so it's very importantly going to depend upon the detail of the tariffs, whether or not there's retaliation, and whether or not there is an end game. And really, without answering that, it's really hard to make an informed assessment.
One of the economic discussions over the last year or two has been U.S. exceptionalism vis-a-vis some of our large trading partners. Let's look at China here. We had some more data about the China yields falling here. As a global economic advisor at PIMCO, what is your view of China here? How concerned should the world's economy be about the Chinese economy?
Well, I think, look, China is huge in terms of the size of the economy now. And importantly, there are some important and I think ongoing challenges, including the fact, they've got the bursting of a big real estate bubble. They have a high unemployment rate among their youth, and of course the rest of the world, including the U.S. and Europe, is going to be more aggressive in terms of resisting a surge of China exports. And so near and long term, it's a challenging environment.
Paul Krugman with us on Friday.
Wow.
It's great to have him. To have Clarida and Krugman's what Bloomberg Surveillance is about. I have on my reading desk, I'm 2 chapters in, Ned Phelps' fabulous book summarizing his work. Explain why people should read Ned Phelps.
Well, Ned, my colleague and dear friend for 35 years, is literally one of the giants of economics, won the Nobel Prize, incredibly creative, along with Milton Friedman, essentially began to define modern macro, and also his work on growth and innovation and entrepreneurship, just a treasure and brilliant. And
so brilliant, he had a second career with dynamism and the enthusiasm of the economy. You heard it from Richard Clarida, don't take it from me. I'll get Phelps' new book out on Twitter and LinkedIn. It's a jewel. He even mentions Clarida. He was a dean of the department. You got it. He gave Phelps his parking spot.
I should say, during my 4 years as chair, we had 3 Nobel laureates. So
here we
quite
go.
A nice run. Yeah.
This is what AEA's like. They sit at the bar and go, well, I had 3 Nobel laureates.
Phelps, Mundell, and then Stiglitz, and then Vickery before that. Yeah.
And you were not on speaking terms with any of them. That's
no,
great. We got to go and talk the fire. Richard Clarida, thank you so much.
Thank you.
PIMCO.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Lindsay Newman, I really can't say enough about her perspective here. She's with GZero Media, and they're out with their top 10 risks, and sort of pretty grim about it. It's like a GZero world, and he's looking at it as a jungle here. Lindsay, sure. Have you been reading in on Greenland and Panama?
Absolutely, Tom. Who hasn't? I have to say, I've been to Panama. I have not been to Greenland, certainly flown over Greenland, living here in London. Look, what we heard yesterday from the president-elect Trump is really what strikes me most, Tom and Paul, is this is not an isolationist story, right? If we think about the first term of President Trump, the Make America Great Again, America First, it was really about bringing jobs and manufacturing back to America. There was a concern about the U.S. turning inward. When we see him yesterday talking about perhaps annexing Canada, making it the 51st state, taking back the Panama Canal, his ambitions for Greenland. This is a very different set of aspirations that he has for his second term foreign policy approach.
You've got in your top 10 risks, first of all, Ian Bremmer's doing the hoodie thing now. I mean, he's really,
right.
He's really cutting a cash look there. I looked Lindsay Newman. The idea of the rule of Don is one of your risks. Is this a different Donald Trump this time around versus 8 years ago?
This is a Donald Trump who is facing down the prospects of one more term in office. And what we really see from him is he is different. His approach, not just his approach, but also his perspective is vastly different than what has come before him. If we take the nearest example of that, of course, is President Biden. And we know that administration was really about consensus building, negotiations, almost to a fault. So how many envoys did we see, if we take the Middle East theater, how many envoys did we see fly back and forth, Bill Burns back and forth, Antony Blinken back and forth, to almost to no avail. We're still in the middle of the conflict. The hostages are not home. And with Trump, he's taking a very different approach, right? The approach is, let me scan the landscape. Let me look for the points of tension. Let me look and see how the U.S. may be disadvantaged. What are the interests that the U.S. Wants to pursue? And what are the levers that the administration can pull to create forcing functions and advance Trump and Trump's administration's ambitions? And we saw yesterday, and your last guest was just talking about this, we know a couple of those already. Of course, it's going to be tariffs. He sees that as the solution, not just for the trade discrepancies, but he sees it as a solution for how he could perhaps pursue those ambitions with Greenland. And it's also what also came through very clearly yesterday was about energy policy. The differences in energy policy. He's saying, we're going to drill day one. He went on and on about those 625 million acres that Biden has just recently taken offline. That obviously irked President-elect Trump quite clearly. So energy policy is another lever that he's going to be pulling.
Paul, I'm exhausted too.
Yeah, it's exactly. So, Lindsay, how do you think our big trading partners are going to interact and deal with President-elect Trump over the next 4 years?
Yeah, it's a great question. I mean, you're saying, Tom, that you're already exhausted. Paul, you're asking how Europe is going to deal with it. This is actually the calm before the storm, I hate to tell you. And it's been a stormy week for Europe. If you look at what Elon Musk has been saying on X, on that platform, we know, I've been writing in my columns for GZero that, Europe and Trump's allies, the U.S.'s historical allies, they're already packing their go bags. They're thinking about this. How are they going to be prepared? We see, for example, defensive spend is now no longer 2% is not the target. Right. Trump himself said yesterday 5%. That's going to raise some eyebrows in Europe today. But they're looking to be more flexible on defensive spend. Zelensky says he's willing to sit down. Putin has said he's willing to sit down. So everybody's looking to be to know what it is to be in Trump world.
Okay, you got the top 10 risks out. And folks, we're going to, instead of doing this in one interview, which I've told Ian I'll never do, we're going to spread it out over January. We're thrilled that Lindsay Newman can be with us from GZero Media. And, Lindsay, I look what Ian said to CBS. He said it's Trump's way or the highway. What does Secretary of State Rubio do with it's Trump's way or the highway?
Well, we know that Ian is absolutely correct there. He's put in place, Trump has put in place a cabinet around him, or his ambition is to put together this cabinet around him that they all know, Rubio knows that the buck stops with Trump. So Rubio has his ambitions. He has his sort of hardline ways with China, his hawkishness on China, which does dovetail nicely with what Trump is after. But ultimately, it will be Trump's policy, and those around him, like Rubio, know that.
Fascinating. I just, which of the top 10 risks, Lindsay, are you really focused on? Which is I haven't even read the entire document yet, but which is the top risk for Lindsay Newman?
Yeah, well, I will absolutely say that Ian's view of the world and Eurasia Group's view of the world around the G0 winning, which just means that the world is in a point of geopolitical recession. That is the lens through which Eurasia Group is seeing all of those other related risks. And that is sort of a thread line of the world in disorder, the multilateral institutions no longer having that same level of buy-in, the U.S. sort of retrenching and retreating from its role as global guardian. That is the top risk for Eurasia Group. And I would also throw my hat in, and it's tied to Greenland. These issues of ungoverned spaces. I mean, why is Trump so interested in Greenland? He's now saying because of national security, because of its placement in the world. It's the bridge to the Arctic. And we know these ideas like ungoverned spaces, both in sea and in actual space, will be increasing geopolitical risk for the years and decades ahead.
This has been brilliant. Lindsay, when you figure out what the new Washington consensus is, let me know. Lindsay Newman with GZero Media.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now, adjusting his schedule, is Craig Moffett, who worldwide yesterday put a sell rating on Apple, guiding down 20%, 23%. Who's counting? Let's start with a why, Craig Moffett. Why a sell on Apple?
How are you? Good to see you again. Look, this is really a valuation call, but look, the market overall is pretty frothy valuations. But Apple, even relative to the Mag 7 peer group, is now extremely stretched with a PEG ratio of around 3, where the rest of the Mag 7 trades with a PEG ratio of around 2. So there's this perceived safety in Apple. Wonderful franchise, very dedicated customers. But there is no safety when you're paying 33 times earnings for a company that's growing organically in the very low single digits, and even with buybacks, earnings are still growing at sort of half the rate of the rest of the Mag 7.
When I look at it, it's the idea of a sell rating. That means a fractured free cash flow. Are you suggesting this will filter down in the mix of cash from operations, CapEx, and then finally free cash flow, where they're going to miss the mark?
No. I want to be clear. We're not saying Apple is a broken company. I want to come back to some very real risks that we should talk about. But Apple's not a broken company. It's a broken valuation, and there are, as I said, some significant concerns that ought to be reflected in a lower multiple, or at least a more sober multiple than what you've got right now. You know, there was this narrative over the past couple of months, particularly into the last couple of weeks of last year in 24, where everyone was talking about the fact that Apple was, quote unquote, melting up in the face of no news. In fact, there was actually quite a bit of news, and it was bad, or at least sobering and concerning news. Obviously, the risk of retaliatory tariffs when we got a Trump administration, but more saliently, over the last couple of months, you've had the judge in the Google antitrust case say that the payments that Google makes to Apple for search, which, remember, that's 25% of Apple's operating income, are patently illegal. Now, we don't know how those will change, but there's obviously a risk that they do. That ought to be reflected in the multiple. And then there's real deterioration in China, and some obvious concerns that with China, the Chinese government is obviously not going to allow Western large language models to answer questions in China. So you're going to have Chinese partners. That's got to be contemplated with margins and all that sort of thing. So again, nothing says that Apple is broken. Although one more thing, there are real concerns about whether AI is going to drive the kind of upgrade cycle that seems to be discounted in the stock. We're pretty skeptical. But Apple's not broken. It's the valuation that's broken.
So, Craig, given that the valuation may not reflect some of the risk here, I want to go to the China risk here, because I think one of my concerns, I think the concerns from a lot of investors is this is a market that was seen as a growth driver for Apple, and maybe it's not going to be going forward given the improved competition, maybe the sense of nationalism in that country in terms of, buying Chinese products. How do you view China as a risk factor to the Apple story?
That's absolutely right. Remember, Greater China is the second most important market for Apple. And you've had a couple of things happen since the big 5G upgrade cycle back in 21-ish. First, you had the real growth and empowerment, I suppose, of Huawei in China, where after the U.S. banned exports to China or chip exports and the like, and tried to limit Huawei and banned Huawei equipment in the United States, Huawei had to turn internally and actually has done quite well, developing quite credible products that are now driving a significant amount of Chinese market share. You've also got companies like Honor and what have you that have built a much more competitive handset market in China than what we've seen in the past. So it's simply not realistic to think that Apple is going to have the same kind of market share that it had in China. Yeah. And then the Chinese economy is soft, and so you've got relatively slow growth in China anyway. And then, as I mentioned before, you've got limitations on what China is going to allow Apple to do with respect to AI.
So, Craig, we've seen Tim Cook go to China on several occasions, trying his best, given the importance of China to the Apple story. What's the risk to their supply chain, Apple's supply chain here, when we have a Trump administration coming in, which might suggest, just higher tensions between the two countries?
You're right. These kinds of risks are really hard to map out. Last time under the Trump administration, Apple was exempted. So remember, almost all of Apple's key components are imported and in large measure from China. Those imports were exempted, and I suspect it probably would be again this time. But you also have the risk of retaliatory tariffs that could be related to entirely separate products, automobiles or something. And in other countries where you have where Apple, as an ambassador of the U.S. and with a clear U.S. identity, could face real tariffs elsewhere in the world.
Right, Craig. We've got time for one more question. It's so important. Comcast. You've got to buy in Comcast. It's back to a 2017 pricing. I mean, it's not doing a Warner Brothers Discovery, but it's moldy. What would you suggest to Brian Roberts that he needs to do to make a permanent force out of his Comcast?
Well, remember, Tom, you started that question by thinking about the media side of Comcast. And while the media side of Comcast is important, it is still the tail, and it shouldn't be wagging the dog. Comcast is primarily a cable infrastructure company, and they have actually a lot of advantages in cable infrastructure, not least that this convergence world that we're heading into really favors the cable operators because they can offer mobile everywhere that they offer broadband. The telephone companies can't come close to doing that. So I think the real story of Comcast is actually on the cable side, not on the media side.
Right. One of our interns made up the notes, Craig, for you on short notice. Thank you so much for joining. And they thought we were talking to Nathanson, so they said, ask him about the Yankees. Craig Moffett.
Hey, I'm a Jets fan, so if you want to talk misery, talk about the Jets with me.
I mean, it's painful to say the least. I mean, it's been clumsy. The Jets have been clumsy.
Brutal.
Yes. Craig, short notice on the way to the airport. Thank you so much for joining us today. His sell rating on Apple, that made global news yesterday for MoffettNathanson as well.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
The Lisa Mateo Hour, hugely anticipated. We go to Lisa Mateo now for the newspapers. What do you see?
All right, so last night the kickoff to the new high-tech golf league, TGL. You've been hearing all about it,
here.
right? In the sports
No
reports.
interest.
Oh, you have to, because this is the future, okay? So Tiger Woods, Rory McIlroy, they envisioned it for years, right? Finally kicked off, 15-hole match, under 2 hours to complete, okay? So that's the thing there.
Is there a clock?
There's not. You know what? That's a good question if there is a clock. But it did go under 2 hours.
Are they quivering at Augusta, oh wise one?
No, they actually, though, in the traps, in the bunkers, they use the sand from Augusta National.
Isn't that cool?
Yeah,
that is pretty cool.
It's a made-for-TV thing. It's to bring in the younger demos, the younger kids.
Yes.
I did not see
Your
it.
thoughts?
It's fine. It's fine. It's just trying to make golf more fun, more accessible to more people. Take it out of the stodgy country clubs. Let's make it a little bit more like a man cave that a lot of guys are just,
Is it Top Golf?
It's something like that.
Kinda, because it's like a
Top Golf.
simulation.
Wait. Lisa, have you done Top Golf?
I have. I love it. It's so much fun because you have food and drinks and you just go crazy.
Like you're doing the tees with a margarita in your hand?
Yeah, but in Top Golf, though, you're actually hitting into the This one is more like video screen, like a simulation, too, for this one. So that's the thing behind it. But
I'm not getting a lot of love
party.
over here, Paul. You're not like...
No, it's not for me, but it's
not
hopefully
for you.
it's
Next.
for
Well,
others.
DJ Khaled was there. They had music, DJ, people
Again, not for me.
chanting, screaming. It's a big party.
Next.
But you're right, next generation. So ultra-processed foods, are they really bad for us? Okay, this is a question a lot of people are asking. There was a study out, the Wall Street Journal pointed to it, and it said eating packaged foods doesn't automatically result in overeating or weight gain as long as you stick to foods that are low in calories per gram, don't have these certain combinations of fat, salt, carbs, and sugar. So let me give you an example of what you can do, Tom. You can avoid foods that clock in at 2 calories per gram or more, like frozen meatballs. There you go. Stick to those at around 1 calorie per gram, like low-fat flavored yogurt.
Okay, but just...
See, she has a smile on her face because
she's laughing at us. You should see her breakfast, folks. It's like 1,200. It's like 200 calories. Isn't it about? Okay, you can cheat on this, but you got to have wicked small portions.
Smaller portions, yes, that is key. But moderation, like if you do have these ultra products.
Cracker Barrel does not believe in small portions.
No, they do not.
I'm reading David McCullough on Paris right now. In 1830, the Americans were complaining about the small portions in Paris. Nothing's changed, right?
No. Yeah, they do have tiny portions.
Look, we watch it's like Goodbye Columbus. They're at the dining room table, and Jack Klugman's going, "You eat like a bird, Lisa. You eat like a bird." Next.
Okay, Tom, I have another social media platform to you to join. Okay, ready? It is Blue Sky. Okay, so it's not really new. It started in it was an extension of in X, an internal project, but it launched about a year ago. But sources telling Business Insider it's in the final stages, raising new funding led by Bain Capital Ventures. Could value the company at around $700 million. So could give X some competition, who knows? But it's really been on the rise. It grew from 25.9 million users in 2024, and it started about a year ago. So it went from 3 million to 29 million.
I mean, people are looking for alternatives to X, but
yes.
We'll see. It's still out there, and nobody really cares if it's profitable anymore or anything because it's Elon Musk.
They don't sell ads.
From where I sit, X has actually picked up breaking news momentum. The reality at 1 a.m. last night is I'm watching Los Angeles Scanner on Twitter, and I'm watching it with all the fire people in that, and it's some guy in his house. Yep. On Twitter, telling you exactly what's going on street by street.
Yep. They become the journalists.
This bad mouth on Twitter, I don't get. I see everybody using it. Next.
Okay, last one. That big casino complex in Manhattan's Hudson Yards, they were pitching it $12 million. Well, actually got shot down by Community Board 4. So that's a big black eye to it. It had this 80-story tower, wanted to bring all this casino to the Hudson Yards area. The members are saying, you know what? It's just a nightmare. It's going to bring traffic, emission problems, but the vote still has to go to the city council to sign off. So
thank you for not doing congestion pricing today.
You're welcome.
It was congestion free.
Yes.
Very good. Lisa Mateo, thank you so much. The newspapers this morning.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.